Welcome everyone to our webinar today. We're going to be covering the opportunity zones and how they can be combined with the Housing Trust Fund program. So for today, we're going to be, I think probably a little bit under a 90-minute webinar. And we're going to be explaining about what trust funds are, housing trust funds, the requirements that relate to them. We'll also do the same thing with opportunity zones and help you to understand how this could be a useful tool for you. So this presentation is a webinar that's done in conjunction with a written guide and an e-guidebook that was produced titled Using Housing Trust Fund and Housing Trust Funds within Opportunity Zones guidebook and it's the brochure itself covers both home and trust funds. And this was developed as a resource not only to help explain the basics of both programs, some of the challenges related to this, but also with the idea that for an OZ developer who needs to learn the basics, is looking at a potential opportunity, or for a grantee that it wants to market or encourage this combination, that this would be not only a resource to help your own staff to be able to understand what the opportunity might hold for you, but also as a useful tool in helping to explain what those requirements might be for others. So I would really encourage you to look to the Home and Housing Trust Funds within Opportunity Zones guidebook, and that can be found at the on the HUD Exchange, and this is a live link that has been included in the slide for you, and we will have a resource page, a couple of resource pages throughout this training. So I think we'll take just a moment for quick introductions. I'm joined today by my colleague, Carrie Kronberg. Carrie, want to quickly introduce yourself?
Hi, everyone. I'm Carrie Kronberg with ICF, and I will be your co-presenter with Les today.
Great. And I'm Les Warner, and let's just jump right into the materials. So a little bit of an overview of what our goals are for today's webinar. We want to make sure that we assist folks to kind of think strategically about how combining housing trust funds with opportunity zones can be useful. And as part of that, we're going to be identifying some of the potential investor motivations and thinking about how might we recruit potential OZ investors and development partners. So needing to understand how this will work for them and what might motivate them or interest them in partnering on this. And we're also sort of inversely going to be covering the Housing Trust Fund program and helping identify those key opportunities that the combination or bringing housing trust funds into a potential opportunity zone project how that might assist for the goals of that particular project. And as part of that, we're going to spend some time talking about, what some of those challenges are, where there are differences between the two regulations, and trying to help folks think through what that combination, how will that work, and what some of the key challenges might be, and some ideas on how to try to address those challenges when combining housing trust funds in an opportunity zone. So in this session, we're going to be doing sort of a 101 basic. Initially, our first step is going to be on opportunities zones themselves, walking through the basics of what they are, how they work, who can access them. And then we'll do the same with Housing Trust Fund. So we'll provide the basics of that program, the rules that would apply. Once we've established the basics for both programs, then we'll begin to talk about that combination of combining housing trust funds within an opportunity zone, and as part of that, then analyzing what are the opportunities that combination can provide for us, and then followed with what are some of the challenges when we combine those two sources of funding into a project itself. And as I mentioned, we're going to be identifying some of the resources as we go through this to make sure that you also know where to go to learn more on any of these topics that we are covering. So let's start with the 101, the basics for opportunity zones. So opportunity zones were created by the 2017 Tax Cuts and Jobs Act. And the goal of this was to generate long-term investment in both rural and low-income urban communities across the nation. And so to date, at the point that these materials were put together, the IRS has designated nearly 9,000 qualifying opportunity zones. And so what the Opportunity Zone program is it's a tax incentive program, and it's designed to attract investors that have experienced capital appreciation, and so they have a tax obligation, and so otherwise they'd have to be paying capital gains taxes for the sale of their assets. And so this is then based on these geographic locations that have been designated by the IRS. That's based on low and adjacent moderate income census tracts across the country. We mentioned that so far there are 9,000 of those qualifying opportunity zones. And what this allows the OZ investor to do is to invest in a range of economic development activities in the OZ. And I just want to mention that housing, affordable housing, does qualify as an economic development activity. So depending on the term of their investment, the individuals, or it could be corporate investors, would be able to defer the payment of taxes and generate additional returns on those investments when they invest in economic development opportunities within an opportunity zone. So it's that prospect of increasing returns that will attract a substantial amount of investment in those communities, and so we're hoping that then will cause these additional investments that would not otherwise have been invested. So the return to the investor in an OZ project, they increase depending on the length of time of their investment. So with increasing time, those benefits will go up. So increased benefits are generated after 5, 7, and 10-year time periods. And so if an investor invests funds for at least 10 years, then any additional capital gains that are generated after that initial 10-year period can be excluded from their tax obligation. So because of that, really the OZ investments are market driven, where we have investors and project developers are negotiating the amount of investment and the capital returns on that. And so the industry observers suggest that trillions of dollars of unrealized capital gains may prove to be a valuable source of capital that could potentially be invested within these opportunity zones and could result in affordable housing, which obviously is something we are really hoping for. So the OZ zones, it's not a federal grant program. It's not a traditional form of capital for affordable housing. So, when we think about other more traditional housing resources like the low-income housing tax credit program, the tax credits are a tax incentive to investors investing in affordable housing, but you're going through a process where the IRS awards a specific amount of low-income housing tax credits to states and territorial areas, and then those designated administrative agencies are then establishing their preferences, their QAP on an annual basis, and then developers are then submitting applications going through that designated agency on a competitive basis. And of course, there's a limit on those allocations that each state receives. So the OZ funding Opportunity Zone program is pretty different from that. So there's no application for the OZ funding. So really it's developers and owners of affordable housing negotiating that investment term with an investor or a fund for that. So as long as the property is located within one of those designated opportunity zones that have been certified, then that developer negotiates the term of an equity investment directly with each of the investors or funds that were created as a way to invest on behalf of that taxpayer that have experienced a capital gain. And so that's how the benefit for those investors is created, providing them tax relief. So unlike when we talked about the low-income housing tax credit program, capital can be generated through the OZ investments, and it's not limited. So there's not a cap on the amount of investments that can be generated for any one of these OZ designated zones. So as long as there are taxpayers with capital gains, there's a potential source of funds for projects located within an OZ. And I did mention that, you know, OZs, they don't specifically target affordable housing projects. There's a wide variety of real estate projects, operating businesses that can benefit, but affordable housing does qualify as one of those economic investments. So the way that an opportunity zone will work, an eligible taxpayer that's experienced a capital gain invests in a project located within that opportunity zone. And that provides the project as it needs to meet the statutory and regulatory criteria. And we're going to be going through some of the details on that. So a wide variety of investors. We could have individuals, corporations, but we also will have a qualified opportunity fund, and we're going to talk about that on the next slide a little bit in just a moment on that. So where we have eligible equity investments, including, and these could be both for new or existing businesses that are located within that OZ community, but it also could include real estate, business assets, that are designated to provide market-based solutions to benefit that community. So let's dive into when we just raised this term, Qualified Opportunity Fund, or a QOF. So this is an investment vehicle that files either a partnership or a corporate federal income tax return and is organized for the purpose of investing in OZ property or businesses. Kind of similar to what we oftentimes see with our equity investors within low-income housing tax credits. So that QOF provides professional management of those investment services. It really allows those investors to be able to, capture the benefit of the OZ investment without the investors themselves needing to have to go through that process of, trying to evaluate feasibility of individual projects. The QOF really handles most of those ongoing responsibilities of asset management that would be related to those equity investments. So there is a requirement that at least 90% of the investments of a QOF must fund eligible OZ investments. And for the qualified opportunity funds, we did a little bit of research on that. The National Council of State Housing Agencies, NCSHA, some of you may be familiar with them, estimates that as of October of 2020, there were 218 qualified opportunity funds that at that point had already raised $46.9 billion to invest in OZ eligible investments. So it could be a significant source of opportunity. So let's talk a little bit about what types of real estate projects are going to be eligible for that OZ investment. So the key requirement, IRS requirement for that real estate investment is that the OZs need to relate to land and building ownership and use. So when an OZ investor invests in real estate as opposed to some of the other eligible business opportunities, the property must be in a qualified opportunity zone, and those, as we mentioned, are designated by the IRS. And so it needs to be, that property needs to be used in a trade or business of the qualified opportunity funds or business. And so I just mentioned this feels a little bit might feel a little bit confusing, but the concept here is that we want to make sure that where we are, this needs to be for new investments within an opportunity zone to be eligible for tax relief under the OZ program. And so our criteria here is that property has been purchased after December 31st of 2017. And the original use of that property within the qualifying opportunity zone is for a qualifying opportunity fund or a QOZ business, or the property was substantially improved based on that funding investment or business. So we're looking for new investment within that opportunity zone. Also, during substantially all of the time, the qualified opportunity funds or business are holding that property, substantially all of the property was in the qualified opportunity zone. So new construction improvements or rehabilitation, they qualify with tangible property improvements, and that includes affordable rental housing qualifies as a business for the Opportunity Zone program. So let's talk a little bit about affordable housing funding in combination with the Opportunity Zone investments. So OZ investors will be most interested or motivated in projects that offer the best returns for their, they of course need to be financially viable, and they're concerned about reducing their risk. So we need to make sure if we want to promote a viable combination, that it's going to offer a good return, but also that it's going to be financially viable, and we're controlling whatever risk they might experience with that investment. So properties located within the opportunity zone can be targeted for any kind of housing. It could be market rate, it could be mixed income, but it also could be low income housing. It could be based on trying to preserve existing housing with reinvestment. So it's really provided that it meets the needs of the investor. We have quite a bit of flexibility on that. To make affordable housing more attractive to investors, that OZ investment can be used in combination with public funds. It could be with investments via things like the low-income housing tax credit program that we mentioned before, new market tax credits, the historic tax credit program. And what these sources do is essentially help the investor have a reasonable rate of return it also can help minimize that project risk for the investor, all of which are things that that OZ investor is going to be concerned about. So the net effect of combining those public funds or tax credits with an OZ generated investment is that it increases the capital that's available for that transaction, fills financial gaps in making that affordable housing transaction viable. And so that's where we would see a particular opportunity for that combination of including housing trust funds as part of that stack of capital to make that project not only possible, but also reasonable for a rate of return for that investor. So before we move on to talking about the Housing Trust Fund program, wanted to identify a few sources on this. So there is a Housing Opportunity Zone website, which is sort of a landing place for information related to the Opportunity Zone program. The IRS also has a Community Development Financial Institutions website, which is also a good source, particularly for the IRS side of the OZ requirements on that. HUD has developed a couple of toolkits for community leaders. And so there are 2 volumes in this. One is an introductory guide that was put out in 2019. And there also is a second volume put out in 2020 that provides some best practices, some case studies as part of that. And that may be useful as part of trying to help potential investors understand this and the benefits of that combination. The IRS does provide on their website frequently asked questions for opportunity zones. So that's something that is growing over time, and that will be a good place to look for some of the more detailed or in-depth questions than this sort of 101 version of the OZ program has provided. I would recommend that you use that. And then the NCSHA, National Council of State Housing Agencies, on their website has an Opportunity Zone Fund directory. So to be able to identify, we mentioned that we had quite a number, I think 200 some opportunity zone funds that have been created across the country, and this would be able to help you identify where those funds were located and to be able to make contact with those funds. All right. So that was talking about the basics for the Opportunity Zone. Now we're going to switch gears and talk about the Housing Trust Fund program and go through the basic requirements of that program. So the Housing Trust Fund program is a formula-based grant program. And so those funds are distributed to states. And so we're going to be talking about going through in this section, providing some basic knowledge of the Housing Trust Fund program, calling attention to those requirements that in particular are going to, we need to make sure that OZ investors are going to be aware of. So we mentioned it's a formula-based program. It's targeted to serving very low income and extremely low income households. So that's households at 30 and 50% of area median income. It's being administered by states or state designated entities. So each state, as part of receiving an allocation of housing trust funds, have identified priority factors for funding in each state will have completed a housing trust fund allocation program. So their priorities, their funding levels are going to be different on a state-by-state basis, and that allocation plan will then call out, what the activities are that they would fund, what their specific eligibility requirements are that they've put in place for any trust fund recipients receiving funding from that state. So it'd be an important starting point to look at that state and what their specific program requirements are going to be. So let's talk about the basic requirements for Housing Trust Fund that the OZ partners are going to want to know. So I would guess that few of the OZ investors are already necessarily going to be aware of the Housing Trust Fund program. And so I think one of the challenges for Housing Trust Fund grantees will be making sure that they're able to review with those potential investors what those key Housing Trust Fund requirements are, helping them to be familiar with that state's particular Housing Trust Fund allocation program, and then identify that grantees process for identifying and reviewing projects that receive housing trust funds as part of that. So, that may be a competitive process that would be part of that. And so we want to make sure these are all questions, things that are going to be essential for those partners to understand. So let's kind of walk through each of these categories on our subsequent slides here. So Housing Trust Fund is a non-appropriated source of funding. So it is funding that has been designated for affordable housing production, and that really works hand in hand with existing federal, state, and local housing programs. And so its specific goal, it's targeted to much lower income. So this is housing that's going to be decent, safe, and affordable for extremely low income and very low income households. And that would include homeless families. And the primary focus of the program is on rental housing. And the importance of this program is that it created a targeted new source of funding for states to be able to try to fill that gap of need for decent, affordable housing that's going to be workable for extremely low income and very low income households. So the program featured requirements, and let's kind of walk through these from left to right. So the requirement is that Housing Trust Fund beneficiaries must have incomes at less than the greater of the extremely low income limits, or which is at or below 30% of area median income, or the poverty line. Now, I will just mention that the rules for the Housing Trust Fund program at 93-250 lay out this language on the income targeting. Currently, it is restricted for households at 30% and below that we just mentioned. If in future years we have a total allocation nationwide of the housing trust funds that is more than $1 billion, then we would have some additional flexibility that we would be able to also serve households up to 50%. But currently at this point, our housing trust fund levels have been less than that $1 billion mark. And so 100% of our housing trust fund grants must benefit extremely low income households. So that's our current income targeting on this. Also within our program requirements are that it allows states for up to 10% of that annual grant to be used to cover their administrative and planning costs. It also sets aside, requires that at least 80% of the funding must be spent on rental housing. We mentioned a slide or two earlier that this is predominantly a rental housing program. That's because of this restriction that at a minimum, 80% of those funds are being used in conjunction with supporting rental housing. 10% of that annual grant can be used for home ownership, and that could be direct assistance or could be rehab or construction. Currently, you will probably not see housing trust funds being used in conjunction with home ownership because of this restriction that 100% of the funds are being targeted for households at extremely low income levels, which tends not to be seen as an appropriate target for home ownership. It also, and this is a significant detail of the Housing Trust Fund regulations, it allows up to 30% of each annual grant to be utilized to provide operating assistance. So for projects that are targeting extremely low income households, having the ability to use some of the funds to provide operating assistance for those projects is an important flexibility within these regulations. So let's talk a little bit about the Housing Trust Fund requirements and what is eligible on that. So the trust funds are being used to either produce decent affordable housing or preserve affordable housing units. And so eligible activities would include acquisition of existing properties. It could be new construction, rehabilitation. Reconstruction is where we have an existing structure that is demolished and replaced. And so if we had an existing structure that was so far gone, we do have the ability to do a reconstruction on that. So our housing trust fund funds are used for production of non-luxury housing. Each state, as I mentioned, will have a housing trust fund allocation, and they're going to provide, that plan is going to provide further details of what that state's specific program has designated as activities that they will fund and any additional rules that will be related to that. So housing trust fund can be provided to a project in the form of an equity investment, could be provided in the form of a loan or a grant. And states, as part of their allocation plan, may have other forms of assistance that they have approved with HUD to be able to do as part of that. All right, so let's talk a little bit about eligible project costs. So those costs are going to include the cost of acquiring the property. It would also include, site improvements, development costs that are related to that. Any of the soft costs that are related to our affordable housing projects. So that might be, legal fees, architectural engineering fees that would be part of that. We may have projects that include demolition, so we might be clearing all or part of a site as part of that housing, either construction or rehabilitation. That's something that would be eligible under the Housing Trust Fund program. Financing costs that are related to our Housing Trust Fund units also could include relocation assistance. So if we permanently or temporarily need to displace existing residents or potentially business, that would be an expense that would be eligible for use of the Housing Trust Fund dollars on that. And as we mentioned, operating assistance for rental housing, each state would have the ability, if they chose as part of their allocation plan, to use up to 30% of their grant award in providing operating assistance. And then, as we mentioned, admin planning costs that are deemed to be reasonable would also be something that would be eligible on that. And so the way those funds are being provided for that project, as we mentioned, might come in the form of an equity investment, but also might be a loan or a grant for that project. So when we talk about, well, how does a trust fund rental housing, how does this actually work? So I think most OZ investors are going to be interested in what those requirements are, and what grantees are going to be reviewing to determine whether their potential project is going to meet those rental housing requirements. So we mentioned that our housing trust fund assisted units must be occupied by income eligible households, and they will have to have affordable rents, and then they also need to remain affordable for a period of not less than 30 years. So that's a housing trust fund requirement. If we have housing trust fund investment, those housing trust fund units have a long-term 30-year affordability period where we will, during that period, have to have income eligible households and maintain affordable rents for that project. Now, as we mentioned, each state is adopting a housing trust fund allocation plan. And so in that plan, they may be laying out additional priorities or targeting of how those funds will be invested in rental units. That may be based on, their assessment of what local supplies are, where there are gaps and needs that need to be addressed with that, with their available housing trust fund units. So as we mentioned, those units are targeted for extremely low income households. In the future, we might have more flexibility to target very low income rather than extremely low income if our total housing trust fund allocation goes over that $1 billion mark. So housing trust funds may need to be combined with other sources, and that oftentimes we see housing trust fund done in combination with project-based assistance just to make sure that they're going to be sustainable long-term with those very deeply targeted affordability as part of that. So similar to the home program, the housing trust fund program requires some standards in place on how we're going to calculate tenant income, both at that initial occupancy and then annually throughout that affordability period. So we're going to define what's going to be counted towards income when we determine, is this household meeting that eligibility requirement? Owners are also required to market those housing trust fund units following that grantee's affirmative marketing plan. And so that plan's going to have some written policies and procedures on, tenant selection policies and how they're going to market the availability opportunity of those housing trust fund funded units being available. So let's look a little more at some of those key restrictions. So we mentioned our rent, our income and affordability periods. We're also going to talk a little bit about property standards, and property standards are going to apply not only at the point that we complete that construction or rehabilitation, but it will also apply during that affordability period. So we mentioned our income restrictions. All of our housing trust fund units must be occupied by income eligible households, and that's going to be the specific income restrictions are going to be based, as we mentioned, on this issue of whether the total allocation for housing trust fund exceeds $1 billion. So for currently, all households, 100%, would have to be qualify as extremely low income households, which is 30% or below. But if that total of housing trust fund allocation nationwide should exceed 1 billion, then we have the flexibility that 75% of those funds would be required to benefit extremely low income households, but we would have the ability for the balance of those funds then to go up to the very low income, the 50% or below income level. When we're determining the income for that household and qualifying them, we're going to be using either the Part 5, oftentimes referred to as the Section 8 income definition, or grantees could choose to use the IRS 1040 long form definition. So really following the 1040 on what is counted as income and what reductions are allowable on that. So for the rent restrictions, that's something that's published by HUD on an annual basis. So HUD's going to set what those maximum rent standards are to ensure the affordability on that. And those rent structure or standards are going to be based on the number of bedrooms. So a different rate for a 2-bedroom versus a 3-bedroom unit. Now, keep in mind that those rent levels that are going to be set by HUD as maximum rent, they include any tenant paid utilities. So if our limit were, let's say, $800 as a monthly maximum rent standard, if that tenant is paying $100 in tenant paid utilities, then that maximum lease rent is going to be reduced by that amount. So we could only charge $700 in rent, because our rent standard on affordability includes all out of pocket, both the rent and those tenant paid utilities as part of that. So that grantee, to be able to make that calculation, is going to establish maximum monthly allowances for utilities. They will annually be reviewing those and approve those. So those would be adjusted over time as they go through that evaluation process. As we mentioned, our affordability period for Housing Trust Fund is required to be no less than a 30-year affordability period. That period starts at the point that that project has been completed, so our construction is completed or a rehabilitation, and then is measured going forward from there for 30 years or more. Housing Trust Fund allocation plan that a state has put in place could have set a longer affordability period, but the 30 years is the Housing Trust Fund minimum standard on that. To be able to enforce that, states are going to be enforcing via a recordation, and that's usually a land covenant or a deed restriction that's going to remain in force throughout that affordability period. If that affordability period is terminated prior to completion, that Housing Trust Fund grantee is responsible to repay that investment. And so that's why they're going to require that there be a land covenant or deed restriction to try to make sure that they're able to enforce that this project will remain as affordable housing throughout that affordability period to avoid the risk of repayment. So we mentioned property standards. So Housing Trust Fund properties must be maintained in a decent, safe, and habitable condition. So upon completion of that new construction or the rehabilitation, that property is going to have to meet all applicable codes and standards, but then during that affordability period, they will have to continue to meet an ongoing property standard that will have been set by that Housing Trust Fund grantee. We want to make sure that those units remain in habitable condition, are going to be decent, safe, and sanitary for those households. That remains as a restriction throughout that minimum of 30-year affordability period. And so we've mentioned have the affordability period in place. It would be enforced through a deed restriction or land covenant, and the rents and income restrictions will apply throughout that period. And just again, the fact that the maximum rents that are set by HUD on an annual basis for this set the maximum, including the rent that is paid by that tenant, but also any tenant paid utilities that would be part of that project. So we also have some additional other federal requirements that are going to apply on this, including non-discrimination, affirmative marketing. The Housing Trust Fund dollars also trigger an environmental review. We mentioned if we are displacing any folks either temporarily or permanently, then there are going to be regulations related to the displacement, but also for acquisition and relocation. Our lead-based paint requirements are going to apply, and then things like our conflict of interest, federal funding accountability, Transparency Act, and then restrictions that apply related to the use of eminent domain. So I will just mention in the guide itself, the e-guide, there is a section that walks you through those other federal requirements, and I would recommend that you take a look at that for a more detailed listing on that. So for the Housing Trust Fund program, the resources that are available for this, there is a Housing Trust Fund guidance that's on HUD.gov. If you want to look at the regulations for this program, it's Title I of the Housing Economic Recovery Act of 2008. And then there is a Housing Trust Fund program topic page. So all of those items related to regulation, guidance, frequently asked questions are related there, are found there, including the annual income limits and also the rent restrictions. And I will just note this last bullet point. There recently have been a series of Housing Trust Fund Basics webinars that have been recorded and will in the near future be posted on the HUD Exchange. And I would recommend if you want to learn more of the details of Housing Trust Fund, that those would be available to you as a resource. With that, I'm going to turn things over to Carrie.
Thank you, Les. So now that Les has covered the basics of opportunity zones and what you all as grantees need to know, and then as well as what opportunity zone investors should know before combining forces with trust fund dollars on an affordable housing project, let's move on and talk about what grantees should know about using HTF funds within opportunity zones. Okay, so what types of projects and activities can grantees seek out in the opportunity zone? So generally there are two ways that grantees can take advantage of the investment opportunities presented by opportunity zone capital. Most directly, grantees could help secure opportunity zone generated capital in housing trust fund projects and housing that is developed in the opportunity zone. And then by including opportunity zone generated capital in that funding stack, grantees can limit the amount of HTF investment in the project. So this is a benefit, right? It stretches those HTF dollars further. There are mutual benefits to investing HTF in an opportunity zone. So first and foremost, as I just mentioned, opportunity zones investments can help stretch those HTF dollars and allow you to fund more projects with your limited public funds. In addition, opportunity zone investors and the jurisdiction as a whole benefit from HTF projects in an opportunity zone because affordable housing can be a stabilizing force within the opportunity zone. Additionally, while HTF funds are for affordable housing, they can also be involved in mixed use and mixed income development. So HTF, of course, those projects need to meet specific requirements, but there is some flexibility in the project profiles, right? It can finance developments that are 100% affordable housing, or, when combined with other funding sources, HTF can finance a wide range of rental housing and in some cases, homeownership housing. Affordable housing funded with HTF can include mixed income housing, mixed use development, and then HTF funds can pay for the affordable units and a fair share of common costs, and also a proportional share of some limited infrastructure development to support these undertakings. So opportunity zone equity and other sources, of course, would be required to fund costs that aren't eligible for HTF. So, we talked about affordable housing being a stabilizing force, right? So many large institutions and companies benefit from housing development that helps stabilize neighborhoods near their campuses. And in addition, these housing developments can provide a source of affordable housing for lower income employees. Corporations that have a prominent presence in the community, they may even have their own capital gains that they wish to invest in opportunity zones for tax purposes. So combining housing trust fund financing and workforce housing can be a way for grantees to tap the resources of certain institutional investors, and then also ensure that some of the workforce housing is targeted to the extremely low income and eventually very low income households that HTF trust fund is intended for. Remember, if a grantee does limit beneficiaries or gives a preference to a particular segment of the extremely low income population, that can only be done if it's described in the action plan. So grantees that pursue workforce housing, if there are any associated preferences with that, must describe those preferences in their con plan and action plan. And then additionally, in an indirect manner, if appropriate housing developments don't immediately exist, there isn't anything in the pipeline for a given opportunity zone, HTF grantees may wish to work with other agencies or developers and investors to support investments in an opportunity zone that may have benefits to residents of nearby trust fund assisted housing. So continuing on this topic, while they can't be funded directly with Housing Trust Fund, another category of activities to consider advocating is non-housing economic development that complement existing or planned affordable housing, as we just mentioned on the previous slide. And that can be things like infrastructure improvements or working capital for local businesses. Opportunity zone investors may provide an influx of money to the community. That's the intent of the program, right? And this capital can stimulate and support economic housing as well as infrastructure development. Um, you know, so grantees and affordable housing developers should explore the potential of this relatively new capital source and take advantage of these funds when those opportunities exist. So talking a little bit more about how to identify economic development activity that can complement or support existing affordable housing and HTF housing residents. Grantees can seek out or encourage investors to capitalize economic development initiatives that will support the grantee's nearby development and its residents. Those can be things like grocery stores, a variety of commercial services, or investment in businesses within the opportunity zone that could create jobs for the housing residents. And remember, while opportunity zone equity is often invested in real estate, it's not a requirement. Grantees and investors can identify other economic development initiatives in the opportunity zone, such as working capital for new or existing businesses, as previously mentioned. Grantees could also coordinate infrastructure improvements that support affordable housing and opportunity zone investments. So jurisdictions can target local capital improvement funds to upgrade existing infrastructure to maximize the redevelopment impact within the opportunity zone. Many successful redevelopment strategies begin with that significant and coordinated investment of public funds, and then that kind of acts like a magnet to attract additional private investments. Grantees can work within their state and local jurisdictions where our opportunity zones are located to coordinate these investments and ensure they support the grantees' affordable housing investments as well. So when we're looking for potential opportunity zone investors who might be motivated to invest in an HTF project, Les talked a little bit about this already, but we'll continue on that topic. So the right network exists, and particularly, HTF grantees at the state level may have an economic development office that has relationships with businesses and potential investors, but so they may be able to identify and recruit high wealth individuals or corporations that have capital gains that they're interested in investing in opportunity zones within the state. Without those existing relationships, identifying and approaching specific individuals and companies could be challenging or a little awkward. So we introduced qualified opportunity funds earlier in the presentation, and it might be easier for a grantee to approach an established QOF, Qualified Opportunity Fund, for investment. These funds were specifically created to take advantage of the flexibility opportunity zones provide to investors. and their administrators will likely be open to discuss potential investments in opportunity zones within the grantee state. Les has mentioned NCSHA a couple times, and that's one of a couple of existing online resources that can help grantees find the QOFs that operate in their regions. So NCSHA is one. They maintain a database of qualified opportunity funds that have been publicly announced. And then there's also an opportunity zone database linked here that lists the qualified opportunity funds that chose to register with that system. So the functionality is a little bit different between these two databases, but they both allow the user to filter by location and the focus of investments. And we'll get into more investor motivation on the next slide. But when you're approaching any opportunity zone investor, remember the primary motivation typically is to invest capital gains and minimize their associated tax burden. So in thinking about the motivation to invest, we have two primary categories of investors. Most are driven primarily either by profit or by mission. All investors will look for financially sound projects, but mission-driven investors may be willing to accept lower rates of return in exchange for a public benefit. But first, let's talk a little bit about profit-driven investors, which are probably more abundant. Most opportunity zone investors will fall into this category. And again, they seek to maximize the financial return on their investment. And in order to do this, to maximize their return and receive the greatest benefit from the capital gains provisions associated with an opportunity zone project, the investor has to remain in the partnership for at least 10 years. Profit-driven investors will likely want to exit the partnership as soon as that minimum period is complete, because there's no additional benefit to them to leave the funds in the investment for a longer period. HTF grantees and developers working with profit-driven opportunity zone investors will need to consider that, right? They'll need to understand the investor's exit strategy during underwriting. And we'll talk a little more about this when we get into challenges later, but in short, you have your 15-year low-income housing tax credit compliance period and 30-year housing trust fund affordability period, and that can complicate the use of opportunity zone investment funds in projects that combine these sources of funding, because you have a 10-year period, a 15-year period, and 30-year period. They're not aligned. So grantees can consider finding mission-minded investors who may be willing to forego shorter-term gains and leave their investment in the property for longer than that 10-year opportunity zone requirement. Additionally, these kinds of investors, particularly if they're local or regional, they may already have ties to the community. They might be driven to engage the community for input and ensure that opportunity zone investments have a broader benefit beyond just being financially sound. And then mission-minded investors operate both locally and nationally, and you can find local and regional investors in this category by using the databases that we linked on the previous slide. But here we've listed two national mission-driven opportunity zone investors, and they are the Local Initiative Support Coalition, or LISC, and Enterprise Community Partners. Okay, so next let's talk specifically about how to find and take advantage of opportunities for using trust fund dollars in combination with opportunity zones. And we'll take you through a few steps of considerations and actions that grantees can take. So first, for grantees seeking to work with developers and investors in opportunity zones, they need to be proactive. So grantee staff should learn as much as they can about the Opportunity Zone program and the location of any opportunity zones in their state, if staff aren't already involved in efforts related to opportunity zones there. In many cases, and particularly since we're talking about states with housing trust funds, the department or agency involved in attracting and facilitating development within the opportunity zone might be different from the department or agency administering the HTF program. So HTF program staff probably have a little bit of homework to do to get up to speed on the state's efforts and involvement in the opportunity zone program. As part of this, grantees should identify the opportunity zones within their states. They should understand where those are and determine whether any proposed HTF projects in the pipeline overlay with those opportunity zones? Are any of them located in opportunity zones? If there are planned potential trust fund projects within the boundaries of an opportunity zone, then the grantee may want to encourage developers to seek opportunity zone equity as an additional source of gap financing. It is important to note, though, in many cases, housing developers lead that effort to, they're looking everywhere for affordable housing sites and funding. And so they would probably be aware of opportunity zone investment opportunities. Okay, so next you want to assess the viability of affordable housing in the opportunity zone. So you're taking a look at an opportunity zone and, what's the character of that area. And this can be done while the grantee is going through its periodic planning and consolidated planning process. Here's when they can evaluate opportunities for affordable housing investments in the opportunity zones within the state. And then any identified opportunities could inform and be a component of the grantee's overall comprehensive housing affordability strategy that's outlined in the consolidated plan. Grantees could also use charrettes and other planning tools to seek input on strategies for future investments within opportunity zones. So when reviewing potential affordable investment opportunities in opportunity zones, grantees can identify vacant land that might be well suited to new construction. They could also look for older deteriorating structures that need rehabilitation and are situated in opportunity zones, and consider whether these sites are appropriate for residential use. Additionally, grantees should look at whether the state or local jurisdiction might own any land within an opportunity zone that could be suitable for housing development. And there are a number of considerations to take when evaluating sites. So if you're looking at a site, what type of housing makes sense? Is it appropriate for HTF funded housing, which most likely is going to be rental housing? Looking at zoning and context to determine the appropriate size and scope of a project. Can you do some back of the napkin preliminary financial calculations that suggest that an HTF assisted project could be feasible on the site? And if a site isn't already publicly owned, is there a plan to obtain site control? Have you done a preliminary site control assessment to indicate that the site could be attainable for affordable housing development? Is there a willing seller if the site is privately owned? When thinking about potential development partners, keep in mind that typically an opportunity zone investor is seeking investment opportunities and they're not a housing developer. So for grantees working to attract affordable housing development within an opportunity zone in their state, they should identify potential project sponsors or developers that are interested in pursuing a project. And then once identified, the grantee can facilitate introductions to opportunity zone investors, particularly if they've identified mission-minded investors. We talked about how to find potential opportunity zone investors a couple of slides ago, when we talked about both profit and mission-driven investors. And you can find more depth and additional ideas in the guidance in the e-guidebook in the section on how a grantee can find potential OZ investors who might be motivated to invest in home or HTF projects. Another way to attract potential partners is to consider providing incentives to developers who propose projects in an opportunity zone. And those are also in the e-guidebook. There's a section on that called How Can Grantees Create Incentives for Developers to Construct and Rehabilitate Affordable Housing in the OZs. And we'll discuss some examples of incentives in a couple of slides. So as with every affordable housing project, collaboration is critical. All key team members should understand the various funding sources, motivations of each of the partners, and the associated requirements with housing trust fund dollars, opportunity zone investments, and then of course any other funding in the project. So earlier in the presentation, Les covered what opportunity zone investors need to know about the HTF program. And then, so during this collaboration stage, grantees can take that information that we've shared and use the guidebook to educate Opportunity Zone partners about trust fund requirements to ensure they understand the opportunities as well as the limits of these financial resources. The effort should combine both education about the program with promotion of the benefits of Housing Trust Fund to investors and developers. Some of that conversation can include, HTF grantees sharing examples of existing HTF funded affordable housing, and that demonstrate the quality and stability of well-managed rental projects that have been underwritten and funded to ensure long-term viability. Based on available data, the grantee may also be able to demonstrate the need for affordable units and the challenges low-income households face to find available, decent, affordable housing in the local market. That demonstrated market demand, can also help show the Opportunity Zone investor the risk is really mitigated here, right? We're going to be able to find tenants for these properties because this housing is in such high demand. And then additionally, to explore the viability of using Housing Trust Fund in an Opportunity Zone for a specific project, grantees and their partners can access several tools that are provided in the e-guidebook that can help guide collaboration efforts. So, we had a section already in this webinar about the HTF Program 101 Basics, referenced that. So you can use that as a guide to share key information about the trust fund program that Opportunity Zone investors will need to know. And then in order to collaborate effectively, grantees may also need to educate their own staff and development partners about opportunity zones, how the incentive works, what motivates an OZ investor. And this understanding will help grantees ensure that HTF projects are structured so that opportunity zone equity investments meet the IRS requirements. And the Opportunity Zone Basics 101 chapter in the e-guidebook can help grantees educate themselves. Okay, so let's talk a little bit more about incentives for potential partners to develop affordable rental housing within opportunity zones. So some ideas that grantees can implement when incentivizing affordable housing in opportunity zones include using the competitive funding process to award HTF funds, and within that process, providing a preference or maybe additional points to projects that leverage opportunity zone equity investments. If the grantee is lucky enough to have site control or has identified a willing owner and local government partner associated with a specific site in an opportunity zone, they might want to seek even site-specific proposals that align with the affordable housing investment opportunities identified in that comprehensive housing affordability strategy that's in the grantee's consolidated plan. So we talked about that in step 2 a little bit earlier. Another approach to incentivization is to encourage other public departments within the grantee's jurisdiction to go in with them and develop a package of public sector support. So that could be for HTF grantees at the state or local level. So depending on how housing development is governed in the state agencies may be able to offer a variety of resources, not least of which is funding. So for instance, perhaps another department could offer funding for infrastructure in support of housing development, and the grantees department could, offer HTF to complement that. And then working with local government partners, they may also be interested in offering incentives such as waiving fees or requirements, such as parking requirements, offering density bonuses, or deferring taxes. And then additionally, when working to attract potential opportunity zone investors to combine their investments with HTF, you really want to emphasize the minimization of risk created by including HTF in the financial package. We talked a little bit about this earlier, but any investor is going to be very interested in what's my risk here, right? So including HTF lowers the amount of private debt that's needed for the project. HTF projects are carefully underwritten to rigorous standards, and that ensures that the projects are financially sustainable over a much longer period than even the minimum opportunity zone investment period, right? Additionally, a trust fund requires regular inspections and long-term monitoring, and that includes, looking at the financials of a project. So funded projects are regularly subject to outside evaluation. Any financial red flags will be identified pretty quickly, right? These projects operate under careful oversight. And then finally, the grantee should toot their own horn and emphasize their experience administering and complying with complex federal programs and requirements. So our last topic is talking about some challenges to using housing trust funds in opportunity zones. So the HTF program and opportunity zone programs were created at different times with different objectives, and there are some rubs when you put those together. So in this next section, we'll raise a few potential challenges and strategies for the grantee to overcome them. So let's talk through the potential obstacles to address in order to execute a successful housing trust fund and opportunity zone transaction. So the opportunity zone industry is relatively new, right? This just came out in 2017, and the relationships between parties may be new. So by addressing challenges up front, the parties are more likely to accomplish mutually beneficial goals. So the first challenge may be the learning curve for all parties on the opportunities and challenges that the combination of resources may offer. Um, we've talked a lot about educating ourselves, educating investors, and that's part of the key here, right? We have new programs, new ways that they combine, and we need to all understand as well as we can, each of the programs. So grantee staff and the affordable housing developers team may need to educate themselves about opportunity zones, how they work, what motivates investors, and opportunity zone investors in turn will need to learn the basics of trust fund and any other affordable housing funding sources that may be used in the project so that they're aware of the associated requirements, that they know what they're getting into. And then we'll talk a little bit more about this challenge on the next slide, but coordinating the requirements of many funding sources can present challenges. So partners need to communicate needs, concerns, and requirements clearly. And then you have to do some careful negotiation through the project details. Another potential challenge is that the opportunity zone investor might not be used to a high level of government involvement in projects in which they invest. And so to attract opportunity zone equity to affordable rental projects, the grantee may need to emphasize their experience in administering federal programs and complying with federal requirements. As we just mentioned. And the grantee and developer should also be prepared to thoughtfully carry out the applicable federal requirements in an effective and non-threatening way. As we've discussed already, the affordability period is 30 years for housing trust fund projects. Opportunity zone investors seeking to maximize their financial return typically invest in projects for a period of 7 to 10 years. So if an investor requires the maximum financial return, they may seek a viable exit strategy that includes the financial restructuring of the project that's at a period consistent with their objectives. So as we've talked about, some mission-minded investors may be willing to leave their funds in the deal long enough to match the full extent of the HTF affordability period. However, you should work that out at the beginning. If the parties anticipate that the opportunity zone investor will exit the project before termination of the HTF affordability period, then the grantee, the developer, and opportunity zone investor need to agree upon and carefully map out the exit strategy at the outset. Another challenge is related to timing. So an opportunity zone investor has its own constraints to manage once they realize a capital gain. They generally have 180 days to invest an eligible gain in an opportunity zone qualified project, or for an investment or individual project, or into a qualified opportunity fund. And of course, housing trust fund grantees can't make a commitment of HTF funds until they have firm financial commitments from all other sources. And additionally, the grantee has to do a pre-commitment review of the project's feasibility ensuring that it'll comply with the environmental provisions, and they have to complete their underwriting and subsidy layering review. So grantees, developers, and opportunity zone investors have to plan for and manage these timing considerations for an equity investment to be effectively executed with an individual opportunity zone investor in particular. So effective communication about the constraints grantees are subject to, and the timing of all of the processes is critical for success. And then I think communication is kind of a key thread here, right? Opportunity zone investors also need to communicate clearly about their deadlines, and grantees may need to take a look at their processes and prioritize opportunity zone projects to accommodate opportunity zone timelines. So if a grantee has, say an annual funding cycle, that might not work. So if you want to foster opportunity zone investment, you might need to take a look at your own timing and see if you can be a little bit more flexible. And then lastly, a high rate of return may not be realized in affordable housing projects. They're stable typically, but you might not produce the highest capital gain on themselves. So grantees may want to focus on mission-minded investors for projects that are 100% affordable. And then they may consider funding mixed use or mixed income projects that have the potential to foster higher returns if they're looking to attract more profit motivated investors. So one of the challenges we touched on in the previous slide that we felt deserved a little bit more attention was coordinating multiple funding sources. So experienced HTF administrators are probably well aware of, coordinating multiple sources because the sources in a capital stack for an affordable rental project, the number varies depending on the nature of the project. In some cases, maybe there's only one or two, but it's much more likely there will be 3 or more, 10, could have a lot of different sources. So typically sources include debt, a first mortgage loan or a first mortgage loan, at least one source, but often more of soft debt or grant from the government. That could be HTF as well as other federal, state, or local sources. You'll often have a third-party equity investor, and that would include the opportunity zone investor. And in many cases, a general partner or a developer will contribute equity as well. In the developer's case, that might be a deferred developer fee. So ensuring the requirements for each funding source are met can be a challenge. And once again, communication is the key to success. So partners need to understand the needs and requirements of each funder, and project details should be carefully negotiated so that all requirements are met. You got to be thoughtful and patient in your coordination, and especially when working with new partners where there might be some growing pains if folks aren't used to working with each other, that can be absolutely critical. So we've covered a few resources throughout, and we have one last slide of additional opportunity zone related resources. So first, HUD has an opportunity zone website that includes opportunity zone resources and maps. The IRS oversees the opportunity zone program, and they have the final regulations and frequently asked questions are available. The Economic Innovation Group, or EIG, has an activity map, and that includes activities that have taken place in opportunity zones. So if you want to see a little bit more about what has already been done, that's a good place to look. And then I think we already talked about how to find opportunity funds. So NCSHA has the database. Novogradac also has a list of opportunity funds. And then there are additional resources for mapping your opportunity zones within your state. So the Enterprise Opportunity 360, the policy map, Urban Institute's Community Impact Assessment Tool, and then finally, MasterCard has an inclusive growth score that can also help with mapping opportunity zones. So that concludes this webinar. Les and I would like to thank the U.S. Department of Housing and Urban Development Office of Affordable Housing Programs for sponsoring the webinar, as well as everyone who's watched the presentation. and I hope everyone has a wonderful day. Thank you.
Thanks, everybody.